Hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, it's the last trading day of the week, given the fact that it is a truncated week, and we've seen 5 straight days of sell-off coming in on the Lal Street, where we've seen crucial levels being broken on the index. 23,530, that was the 200 DMA, and that was violated in intraday trade yesterday. And even the Nifty Bank Index, that was trying to, give some support to the market, but, even that kind of, fell quite a lot yesterday. In fact, it broke below that 50,000 mark intraday as well. And mind you, it was the last weekly expiry for the Nifty Bank Index yesterday, and wasn't really a very great farewell, so to say. But even though the Nifty Bank Index fell below the 50,000 mark intraday, it is still holding on to the 200-day DMA of 49,725 or thereabouts. So that will be a crucial level to watch out for. But the key question is whether or not the Nifty can sustain that 200-day moving average level or not. That's the big question that we will be asking our experts, and we'll also be asking some big market voices as to whether or not it is time to call the market bottom, or is it too early to really call the market bottom? Because remember, Macquarie has said that they are expecting another 10% kind of correction over the next 3 to 6 months. So that's a very cautious tone that Macquarie has hit, but we'll find out whether other experts are in agreement with that prognosis or not. So yes, lots to watch out for on this edition of Opening Bell. Lots of stocks, given the fact that we've had the likes of DMart, Zomato, BSE, all of them will now be available for trading in the F&O segment, as well as NSE has given the green light for 45 new additions in the derivative segment. So of course that will widen the spectrum, and of course those stocks will be in focus in today's session. Of course, you may have a lot of queries after the kind of sell-off that we have seen on the Lal Street, so keep sending in your stock related queries. We'll try and take them up. We'll try and take up as many as possible, in fact, and get your queries addressed. But of course, before we move any further, let's take a look at the top stories at this hour then. Of course, starting with Wall Street, stocks ended mixed, with Nasdaq ending in the negative territory. Inflation data came in yesterday, CPI data, and that was largely in line with expectations at 2.6%, and that has raised expectations of the Fed continuing on its rate cut path. Asian markets opened mixed, mirroring Wall Street moves. The Nikkei was trading higher the last time I checked. The GIFT Nifty is also suggesting a lower start for the Indian market, which has now seen 5 straight days of cuts. Crude prices bounce back from 2-week lows, with Brent trading above the $72 a barrel mark. Meanwhile, gold prices have slipped for the 4th straight session as dollar and bond yields rise following the release of US CPI data. Among key earnings today, higher volumes may drive revenue growth for Hero MotoCorp in the second quarter. Also watch out for earnings from Hindustan Aeronautics as well as Bharat Forge. Well, the Nifty has entered into the correction territory now, 10% off record levels. In fact, quite a few sectors, 15 out of 19 sectoral indices have also entered the correction zone. Mind you, the auto pack has corrected 20% from its record highs that it hit in September. Talking about yesterday, mid and small cap indices were hammered, to say the least, and they have been getting hammered on a consistent basis. A day before yesterday, also both the Nifty mid and small cap indices saw cuts of somewhere around 1% or thereabouts. Yesterday, the advanced decline ratio, NSE advanced decline ratio, was quite dismal. 1:8, that was the advanced decline ratio. So that was the kind of poor breath that we saw in the market yesterday. And going by what Macquarie has said, they have said that Nifty may fall another 10% in the next 3 to 6 months. Well, that may may appear as a panic kind of a situation, but of course we'll touch base with more experts and figure out whether or not they are in agreement with this statement or not. Of course, another factor that has been weighing in on market is the fact that the US dollar has been marching ahead, and it has now crossed that 106 handle as well, which of course gives rise to concerns that although FIIs have been selling, but now the money may flow back into the US because their currency is gaining more strength and getting more attractive. Let's talk about the FNOQs as well. Put call ratio fell to 0.7 vis-a-vis 0.72, so not much change there. let's talk about the stocks in the FNO band then. GNFC rather, that's the new entrant, and Manappuram Finance has exited the FNO band list. In terms of fund flows, there were concerns that the FI net sell figure would be a little higher yesterday, but of course there was a PNB housing block deal as well where there was a fair bit of buying. So the FI net sell figure is at 2,500 crore rupees in the cash market, but DII has rather continued to buy, and they bought shares worth 6,100 crore rupees in the cash market. But on that note, let me bring on board our technical expert for today. Joining me is Kunal Rambhia of the Streets. Kunal, great to have you on the show. But the big question that I will be asking you today is, can we hold on to that 200-day moving average level, or would you expect 23,500 to be violated on the downside today?
Morning, Nandita. Thank you so much for having me on the show. So if we talk about Nifty performance, we saw the brutal correction, and that's almost 10.5%, as you correctly mentioned. On 27th September, we made a high of around 26,270, and now we are at 23,500. And this correction is severe because we have seen broad market sell-off also, that's in mid-cap and the small cap. But if I just speak about Nifty, this is not the only correction which we have seen in last 4 years. We saw many such corrections. In fact, this is the 5th correction with such kind of magnitude on the larger index. So if I look at the support level, I think 23,500 is a strong support as of now, followed by 23,200. These are the two extreme levels which I foresee on the chart right now. The trend which we have seen from 2020 so far is as of now intact, and this correction seems to be like a buying opportunity, at least on the Nifty front. Stock specific views may change, but I think this is a broader correction where one can think of initiating buys if they are getting comfort at the the valuation front as well as on the charts front.
Right. What about the Nifty Bank Index? Most of the technical experts I speak to are saying that both the Nifty and Nifty Bank Index are giving out bearish signals now. But the good part is that the Nifty Bank Index has been managing to hold on to that 200-day moving average level. Of course, 50,200 I think was one key support level that has been violated, but 49,735, that's the 200-day moving average level for the Nifty Bank Index. Is there a threat that that level may be taken out, or do you think not so much?
So again, in the last 6 months, what we have seen is the Bank Nifty made a similar bottom near to 50,000 3 times. The first was in June, where the bottom was around 49,600. Then we saw August, 49,600 again. We had October, where the bottom was 50,000, and now we are back to that level itself. So on the chart, this looks like sideways consolidation. I'm not denying the fact that the entire positive trend is now getting into sideways consolidation, but trend still remains positive. It's not making lower top, lower bottom, and until Bank Nifty closes below 49,800 or say 49,700 kind of levels, I'll stay comfortable and I'll consider this to be like a buying opportunity itself.
Okay, that's the view on the Nifty Bank Index. But autos, what's your call there? The index is off 20% from its record high in the correction zone now. The likes of Moto Corp under pressure, but today the company is reporting its numbers as well. Would you say that Moto could be a good shorting candidate now?
Okay, so as far as the auto index is concerned, we saw a steep rally, and somewhere November 2023, where the index was trading at 15,800, just a few months back, that's in September, it hit the high of 27,800 without any correction. And the ongoing correction, what we are witnessing compared to that rally, is not even 38% of the entire rally. So these kind of corrections are obviously going to be part of it because we have seen steep rally. But as far as the stock specific behavior is concerned, Moto, yes, it's showing the weakness as of now. But again, the trend remains absolutely positive. 4,400 is a level to watch out for. If the counter manages to stay above 4,400, I will again consider this to be like buying opportunity. I was not comfortable buying near 6,000 and 5,800 because the risk reward ratio was unfavorable. But in the trend following, we always wait for such kind of corrections, and this correction is here. So yes, I think 4,400 seems to be good level. We'll wait for a day or two. We'll see the consolidation happening near that level. Then we'll initiate a buy.
Okay, that's the view. What about an Eicher Motors? Numbers came out yesterday, although the numbers were a disappointment. It was an all-round miss. Margins have missed estimates, but in-field volumes have been encouraging. and here on, the street has taken heart from the company's strategy going forward, because now the shift in stance is to drive volume growth, and which has the brokerages have really taken note of. Nomura has upgraded the stock to neutral from reduce, and target price has also been raised to 4,391. The stock is at 4,700 right now, if I'm not mistaken. Yeah, that's correct. But the stock hasn't really seen such a steep correction in the last 1 month. So, do you see further upside here, or would you say that there is some bit of correction left in the counter?
So again, Nandita, we just go back and check out the last 6 to 8 months performance of this counter. April 2024, this counter gave a breakout of 4,500. And since then, counter has been within the consolidation zone of 4,500 to 5,000 levels. And this consolidation has given 6 trading opportunities. Just one was yesterday itself when it made a low of 45.36, and see that today gap up. Again, it's back to 4,700. It's up by around 3%, gap up opening by 3%. So unless and until the counter goes above 5,000, there is no trending opportunity. But if someone wants to buy near 4,500 and sell near 5,000, I think that can be a good range bound trading. For the day, I will not be touching upon this counter. If I already initiated buy yesterday, I will wait for the price of 5,000 to turn up to exit. But I will not be keen to buy in between because of unfavorable position, the risk reward issue again. But yeah, range trade can always be taken.
All right, that's the view on Eicher. What about all the 45 stocks that have made an entry in the F&O segment, particularly the likes of DMart, Jio Financial, Zomato, Paytm, Nykaa, BSC, some of these stocks have seen a great run. Some of them are, witnessing some bit of correction as well. DMart, of course, has been an underperformer. But, your thoughts on how this would pan out for some of the counters, even some of the Adani Group stocks have been included. Your reaction to this?
So to be very honest, I was literally surprised when I saw Zomato, but always we assume that the price discounts everything. Somewhere in the month of March 23, counter was near to 50, and now it's trading near to 260 in a trend. And now this counter has been added to F&O segment. So, these trends actually were confirming that the counter is supposed to come. I mean, there is going to be some kind of announcement. I will not be surprised to see the consolidation continuing with the positive trend on all these counters. I am a bit surprised on Adani stocks because there is no major trend, and in fact, the counters are not doing anything since last 1.5 year kind of phase. But otherwise, the companies like Zomato and all, I think this can be a good trading opportunity also. Considering the support of 240, I think I'm very bullish on Zomato. So considering support of 240, one can initiate a buy, and the targets can be 295, 300 kind of levels again.
All right, 295, 300 on the upside for Zomato. Addition in the F&O segment, of course, may come as a boost. Naveen had a query on this particular stock. Naveen, I hope this answers your query. But let's take a look at how the markets have really opened up. So some bit of green on the screen. So some bit of a relief in early or opening trade, 23,600 back on the screen, but whether or not it will sustain or not as we progress, is something that, we will watch out for. The mid-cap index is showing strength, 0.9% kind of gain coming in on that index. The Nifty Bank index as well, 50,300 is back on the screen. So that support of 50,200 that I was talking about has been reclaimed at the current juncture. And looking at the breadth, early days to really look at the breadth, but still it's in favor of gainers. So 1,000 advances, 1,500 advances to 471 declines on the NSE. Let's take a look at what the sectoral indices are doing at the current juncture. Most of them have started the day on a positive note. Special mention to Autopack. It has been under intense selling pressure, but today, at open at least, the index is up somewhere around 1% or thereabouts. Even the Realty Pack yesterday, it was among the top sectoral laggards. Today, the Realty Pack is up somewhere around 1% or thereabouts. Metals are showing strength, 0.7% higher on the Nifty Metal Index. Barring the infrastructure pack, I think most of the sectors, or all of the sectors rather, are trading in the green. India VIX saw a sharp spike yesterday. That volatility index surged by 7% yesterday. Some bit of a cool off today, 2% lower, but it is still above that crucial level of 15. In terms of individual movers, Eicher Motors is the top gainer, and that's propelling the auto index because that stock is up 7% as we speak. As I said, although the numbers were a miss, but the shift in strategy is something that the street has taken note of. Aside of that, of course, Nomura has also upgraded the counter, so that's a positive, and the stock clearly reacting to that. IT names continue to see buying interest, the likes of HCL Tech, Pharma as well, seeing buying interest. Sun Pharma among the top Nifty gainers. Cipla, although there is some bit of a setback, US FDA has issued Form 483 for its Bengaluru unit, but still the stock is trading in the green. HDFC Bank, that had fallen quite drastically yesterday and was among the top Nifty, negative contributors on the Nifty, has edged back into the green, 0.5% up for that counter. Wipro, Bajaj Finance, Bajaj Auto, these are some of the other gainers. On the flip side, what's not doing well, some of the power utility stocks, Power Grid is down. NTPC that was holding out yesterday is trading in the red today. Ultratech Cement, BPCL, because I think crude has bounced back from 2-week lows, right? So BPCL reacting to that. Britannia, Hero MotoCorp under pressure, even though the auto pack is doing well. Bharat Electronics, M&M, Bharti Airtel are some of the other laggards. I'll take note of some of those stocks that have, made their entry in the FNO segment. But Kunal, looking at the market open, early days to say whether or not this positive trend will sustain or not. But we did, reclaim that 23,600 mark briefly. Looking at the open, the kind of strength that we are witnessing in the broader markets as well, do you think it's too early to assume that these gains will sustain?
See, Nandita, again, whether markets will remain positive or not is anybody's guess as of now because the short-term trend is certainly negative. But as we were discussing in the beginning itself, this 23,500 and 23,200, these are the two levels. If market consolidates at this level, this present level itself, even for a day or two, I think then we can expect some kind of breather and some kind of recovery coming from these levels. Trend, as we discussed, is still positive, and today's bounce is confirming the same. But let's see whether the market sustains at this level. For short-term trade, what I can suggest you is a breakout level of around 23,640 on the spot level. So if Nifty goes about 23,640, then with the day's low as a stop loss, one can initiate a buy and the targets can be 23,800 kind of levels.
Okay, that's a view on where the markets are really headed. But let's talk about a Vodafone Idea. Stock is not seeing any traction really. Numbers have been good, so to say, because losses have narrowed on a quarter-on-quarter basis. Even the average revenue per user has improved to 166 rupees, on a quarter-on-quarter basis, which is good news really. But the stock hasn't really taken, any heart from that. It's at 7.3 or something at the current juncture. 1 month it has shaved off 20% or so. Would you look at this particular counter within the telecom pack? Does it merit a look, or would you say, given the volatile nature, it's best to avoid this stock?
So this counter actually lost its ground when it fell below 8.5, 8.4 kind of levels. Now it's trading near to 7.4. Unless and until it reclaims that zone, which is lost ground, right? That's 8.4. I will really stay away from this counter. People always try to capture the bottom, but for the bottom to be in place, the counter has to get into sideways consolidation, which is not happening itself on the chart. So let's avoid this for now and revisit this once it reclaims 8.3, 8.4 kind of levels, and then we'll find out some kind of support and we'll try to, go contra on the ongoing trend.
How is Nalco looking on the charts now? Because numbers have been fairly good, multifold jump in profit, and the stock is reacting to that as well, 3% higher on this counter. Although in the last 5 sessions or so, it has shaved off 8% or so. Case to buy this stock? How is this particular stock looking within the metal basket?
So for this year, there are 4 bottoms which were almost equal bottoms, somewhere in the month of May, then June, and then August. And that bottom is 620 to 615. Yesterday's low was again 622 itself. Believe me, it's well poised for someone who wants to go, positional on this stock. The stop loss on this can be 615 on the closing basis. And, let's just continue with the trend. On the higher side, we can expect 700 kind of levels. Looking at the result also, I think this company can do really good, even going forward from the present level. Risk reward ratio is extremely favorable. It's almost like 1:4, 1:5. So yeah, it's a thumbs up on this counter.
All right, a thumbs up on a Nalco. But let's take a look at some of the other stocks that have reported numbers. GRSE, Garden Reach, stock is doing well today. Numbers have been also fairly strong, if I'm not mistaken. Profits up 20%, revenues almost 30%. Margins have also come in higher, and the street has taken heart from the kind of numbers that the stock has handed in rather. But given the fact that some of these stocks have come off quite significantly from their all-time highs and they have been in a corrective mode, is it time to take a relook at these stocks? We have a query also coming in from Naveen on this particular counter. How should one really navigate some of these shipbuilding stocks now?
So again, Nandita, we were discussing about these counters near to the highs also, saying that the risk reward ratio is unfavorable. Let's wait for some kind of correction to initiate the buys. This counter is down by 53% from the high. But look at the trend, it's absolutely strong. So far, there is no trouble. The only reason being from June, where the counter was near to 1300, July itself, it went up to 2800. Now, such kind of steep rallies will always see such kind of corrections also coming in. No major selling volume on the chart. It's good to accumulate, but I will again wait. Let's wait for a month where the counter goes into sideways consolidation and it doesn't really show us a new low. For now, 1350 to 1375 is a strong support. We will wait for the counter to go into sideways consolidation and then we initiate a buy. I am very bullish on defense counters, specifically Garden Reach and HAL. But again, I'm not just trying to catch the falling knife for now. We'll wait for consolidation to come.
All right, that's the bullish view coming in on defense stocks. Let's take up another query. This one is coming in from Anune. He wants to know whether it's a good time to take fresh entry into transformers and rectifiers for the medium term. The stock has seen a reversal in trend over the last 5 days. Although it was in an uptrend, but last 5 days have shaved off over 15% from the counter. Would that be a buying opportunity?
Certainly, yes. So very short-term view is absolutely fine. One can initiate a buy, but as I mentioned, the sentiments also matter. And this week we are heading for a truncated week, even the next week. So a week or two's consolidation will give us kind of better clarity. But otherwise, yeah, it can be bought with just 1.5% stop at the present level, and the targets on the higher side can be 1:2 kind of ratio. But again, I'm not very keen to initiate trades for now on any of the counters like this.
Okay, that's the view then. I hope that answers your query, Anune. The next query is coming in on an IGL. Didn't really get the name of the gentleman, but the view on IGL and MGL. I want to know how you're viewing these gas stocks. There has been a setback in terms of government policy, and since then the stocks have corrected quite a bit. In fact, in the last 1 month, IGL itself has corrected 20%. Would you steer clear of these stocks now? Or would you say that major support levels have been broken, or would you say that 382, that's a 52-week low, that would act as a major breakdown on the charts?
See, IGL, MGL, these counters have been traditionally volatile, and such kind of 30-40% corrections we have seen at least in 3 times in last 3.5-4 years. In fact, the massive correction was somewhere in September 21 itself, where the counter came down from 600 levels to 300 levels, 50% correction. So if I look at the broader chart formation, the trend is absolutely positive. The strong support on the chart is 398 to 400 kind of levels. Just 3 weeks back, we saw the bottom of 400 coming in. I think if the counter consolidates at this level, from long-term point of view, one can definitely take the opportunity of buying near 400 levels. The stop loss on this can be 380. If the counter falls below 380, take an exit. But otherwise, you can think of initiating buying near 400, and the targets can again be 500 kind of levels. But this is absolutely positional view. Considering at least the weekly chart, we can expect the target in probably 3 to 4 months time.
All right, that's the view on gas stocks, particularly IGL. Hope that answers your query. The next one is coming in once again from the defense pack, where you are pretty bullish, but particularly on a Bharat Electronics. What are the levels you'll be watching out for? Because I think last 5 sessions it has seen some bit of a pressure. It has been consistently emerging as the top laggard on the Nifty in the last couple of sessions. Any particular level that one should watch out for here? It's at 280 right now.
Correct. So just let's go back to just a week before and 2 weeks before and see the bottom. The bottom was 265, and this bottom of 265 was held on for almost 3 weeks, and then we saw the bounce coming till 300. Right now it's at 280. So no, this is kind of consolidation which I always expect. Correction, then sideways consolidation, and the continuation. So right now, what I see on the chart is continuation of the previous uptrend. Counter should not go below 265. So that's the stop loss on the closing basis. If the counter closes below 265, take an exit. But otherwise, BL seems good from a positional point of view. Stop of 265, targets can be 320 to 325 in the near term itself. One can certainly initiate buy on this. We have already initiated buy, and our stop loss, as I told you, is 265 itself.
All right, that's the view on Bharat Electronics. The next one is on a CDSL from Harkirat Singh. Now, CDSL, of course, one of the new entrants in the derivative segment. Stock is reacting to it up 3%. In the last 6 months also, it has given good returns. All these capital market stocks have had a great run, but, of course, at the current juncture, most of the, stocks are witnessing or are in a corrective phase. But particularly on a CDSL, given the fact that, it is in the, it will be in the derivative segment now, could that be a near-term trigger, and could that mean that the stock could retest higher levels of 1500 or so in the coming days?
Extremely bullish on this counter. Last 3 months, counter consistently made the bottom of 1350. Recently also, you can see just a month back, the counter was near to 1350 and again bounced back. But this counter is in sideways consolidation. Right now, it's in between. That's 1467. With the stop of 1350, one can always accumulate this counter. This counter has not shown a single lower top, lower bottom in last 2 years' time. So I'm very bullish on this. 1350 can be positional stop loss. On the higher side, if the counter takes out 1600 decisively, then the targets of 1850 to 1900 can be seen very soon. So yeah, I'm very bullish. Stop loss is 1350 on this.
All right, very bullish view coming in on a CDSL, but that wraps up our query segment for today. Kunal, in terms of recommendations, anything that you're spotting?
So, Nandita, I'm very bullish on Mastech. Now, this counter is trying very hard to cross 3,100 kind of mark. If it succeeds in crossing that mark, I think the levels of 3,600 to 3,700 are very likely, because this level of 3,100 is not broken since 3 years. And it's gonna be in all-time high zone. So wait for the counter to give a closing about 3,100. I think this can be a very positional and a beautiful trade with the stop of 2,800. Then we can expect the target of 3,600. That's extremely bullish on end positional view on this. The second is BHEL. Again, this counter has corrected a lot near to the previous bottom itself. So with the stop of 220, one can initiate a buy, and the short-term targets can be 235 to 240. So these are the two counters which I'm watching out as of.
Good morning. All right, Mastech and BHEL, two recommendations coming in from Kunal. Kunal, with that, would like to thank you for taking out time and joining in this morning and sharing your thoughts with us. Always a pleasure. Have a great day.
My pleasure. Same to you, ma'am. Thank you so much.
Thank you. Thanks a lot. Well, on that note, the markets are below that 23,600 mark, but just about latching on to the positive zone. Let's see whether or not these gains sustain or not. The Nifty Bank Index, well above that 50,300 mark. Again, 0.5% gain coming in there. We'll be watching out for whether or not these gains we will sustain throughout the session or not. But on that note, let me bring on board the big market voice that I had promised at the start of the show. Joining me is Ajay Srivastav, who's the CEO at Dimensions Corporate Finance Services. Ajay, speaking after a long time, when we spoke last, the markets were on a one-way trajectory going up, and this time around, it's the completely opposite scenario. The markets are going down, and any attempts at recovery have also been feeble. We have shaved off 10% from record levels. Yesterday, Macquarie came and said that, expect another 10% kind of correction over the next 3 to 6 months. First, would you be that pessimistic, and would you consider another 10 to 12% kind of correction from here? Or would you say that, let's call a bottom here?
No, I don't know who can call a bottom, who can call the top, but I think being 10% more cut from here could be kind of very pessimistic in the Indian scenario. And, worse things can happen, but the fact is that we are not looking at this kind of a scenario in the cup. And, more in context of several stocks that we carry on our portfolio and for the customers, I think that's more important. Index, unfortunately, in India has got several companies which are not performing at all. And therefore, we kind of conclude that India is not performing. Like, when you say the bellwether Reliance, it doesn't perform. HDFC Bank is a disaster, absolute disaster, right? So therefore, if you look at the index per se, yeah, it's a bad thing out there. But if you look at the stocks per se, if you look at some of the, and I think we have to be very stock specific. Look at the capital market stocks; they've done well at this point of time. Whether it's the stock exchange, whether it's an agency which manages mutual fund, whether you just spoke about depositories, they've done reasonably well. Good valuation, good performance, and expect to continue. Take a little longer term scenario for India, and I think these stocks would do wonderfully well. Look at the hotel industry doing reasonably well at this point of time. So pessimism of index, I think, is warranted only because lots of the index heavyweights are today the underperforming stocks of India. They are, I call the dinosaurs of India. They should not be in the index. In a 5 years time frame, I think a lot of them will disappear from the index. And we should look at differently. Look at the kind of money India incorporation has raised in the last 1 year. That's going to be put to use over a year, 2 years. You can't put to use money raised overnight. That's going to give returns of expansions, modernization, debt reductions over a period of time. So, each house is entitled to the view, and it always happens when the market goes down. Everybody thinks the only way is down, but when it goes up, the only way up. But I believe that the capitalization of the Indian corporate sector in the last 12 to 18 months is going to give significant returns in the next 18 months. The Indian companies are not dependent on debt anymore. We are a very resilient economy. Yes, you will have bad quarters. Which guy doesn't have bad quarters? You have a bad day in your life. So why can't a company have a bad quarter or an economy a bad quarter? But net is we have raised so much of capital, which if put to use, I'm sure it will be put correctly, is going to get a phenomenal dividend in the next 2 years. No reason to be pessimistic. Choose your stocks correctly because you should not be riding dinosaurs. That's the problem here in India is that we still look at, has Nestle performed? The guy is not going to perform. He's a bureaucratic guy. Just kick him out of your portfolio. There's so many new stocks. Look at what Zomato did. $80 it came at. Look at what it is today. I sincerely believe it's your mental makeup of being pessimist versus optimist. Look at success stories more than the naysayers at this point of time, and you'll do fine with your portfolio. So no, not pessimistic, very overly optimistic, and I think we'll be fine in the longer run. Don't worry about it.
All right, your words sound like music to the ears. But, talking about success stories, you alluded to Zomato. Let's also talk about Swiggy that made its debut yesterday. In a very gloomy scenario, we saw Swiggy gaining traction after a muted debut, 17% higher yesterday itself. But, there are some concerns, views are pretty mixed on quick commerce, especially, again, I would like to allude to the note from Macquarie, where they've said that unit economics are unsustainable and, too high growth rate assumptions are there when it comes to quick commerce. You mentioned how Zomato has been a success story. What are your views on Swiggy in that sense?
Okay, we have a holding, so we don't really comment on the stocks. The fact is we hold a stock. We bought stock yesterday as well, Dave. So we can just, just for a confirmation. The problem with people like, I'm not saying investment houses that you named or anything, is that these are, these come from what is called, I simply say, Excel spreadsheet guys sitting there and doing the Excel spreadsheet. They don't know the real world out there. They don't know what word innovation is out there. That's why they cannot predict the success stories of the world. That's why they are investment houses and they will remain investment houses because the world has moved on. If I'm an analyst today, my world is this laptop and my models and so on and so forth. It's not the brain of Devinder Goyal and Zomato saying, I'm going to make a Blinkit out of it. Remember when Blinkit was bought, what are the all the analysts in the world were saying what a disaster is going to be and what a success story it is. Innovation, India is not used to innovation. Analysts in Indian stocks are not used to innovation. I think they are deadbeat analyzing cement, steel and saying, okay, if this happens, that will happen in 3 years' time. What you've not understood is the leaders in this company are going to evolve their companies. It's not a static company that they'll keep doing this for the next 5 years. That's not what Zomato did. That's not what Swiggy will do. That's not what Nykaa will do. So, so I would just dump all these reports out and say that we have a market of 1.3 billion people. We need to reward innovation in our economy, and innovation is what bringing you into the new setup, and that's going to reward the shareholders. Dump all these Excel-based spreadsheets. Look at yourself. What do you use today? What kind of products you buy today? And therefore, I would say no analyst in the world has been or will ever analyze a new age company And that's why they missed the whole boat on this all about, which is where PE investors came in and made the money at the end of the day. Don't listen to them, junk their report. They are just Excel spreadsheet guys. They don't understand innovation and leadership. And, so forget it. It's going to be great. India, new age economy stocks, I'm telling you, Pragya, will be great, absolutely great, because our economy, look at 1 billion people. Okay, there are a lot of them are poor, but they will come back to consumer cycle. Just imagine the revolution Zomato, Swiggy's have done to our economy. Look at our payment system. When you go to US and UK and other countries, Europe, or travel to, we are nowhere. We need to look at if you go to China, you can't pay by anything except their own Alipay at the end of the day. This is a different world. Forget the analysts. Believe me, the world is out there is a lot better, and these companies will do very well.
All right, that's about new age, but consumption as a whole, the trend that has emerged from FMCG numbers this time has been a slowdown in urban consumption. How are you looking at this entire trend? Because earlier when we used to talk about rural slowdown, that was the big theme, but now there has been green shoots in rural recovery, but that will take time to really play out. What should one do with some of these traditional FMCG names like HUL, Nestle that have seen quite a bit of a correction after their numbers?
I have not held them for 2 years, maybe 3 years now, and I'll not hold them for the next 3 years for 3 simple reasons. One, the old concept of buy an MNC stock and it'll last you for a lifetime is over, because MNCs don't hold monopolies anymore. D2C brands can be launched on the electronic commerce medias and become as successful as a Nestle or a Hindustan Liver. So keep in mind the fact that the competitive scenario has changed. There's no monopoly there for these companies. Number two, most of these companies at this point in time, yes, there is a slowdown, but also what is happening, what they're not telling you, is that the newer products are coming into the field and eating their breakfast, lunch, and dinner. It's not just the cheeses move, breakfast, lunch, and dinner. A new company, for instance, India came up and said, I'm going to make chemical-free cosmetics and toiletries, right? Listed company. It came out of nowhere, has done reasonably well, it's profitable, it's listed stock. But what did it do? It killed out of Hindustan Liver's products at the end of the day. Can Hindustan Liver respond with this chemical-based products? Perhaps, but it'll take them time to revolve it. And the second most important thing, when I mention innovation, look at the bureaucracy in these companies. They exist for salaries, and their stock options are linked to MNC stock options. Show me one CEO of an MNC in the last 3 years who's done spectacularly work, except for the capital good MNCs. Nobody else has done well. This is a bureaucracy. They will never give you returns. Forget it. They are denizens of the past. So much new stuff is happening. Go to chemical-free companies, cosmetics, and private brands. Reliance is launching private brands. Trent is launching for the Star Bazaar private brands. D2C is launching. Nykaa is launching its own beauty products. Just see the competition there out there. And these are going to be, it's like I think MNCs today, FMCG, are really like a deer caught in the, headlight. They just don't know what to do, and they'll be shot down eventually. So the Nykaas of the world, the Trents of the world, the Reliance of the world will introduce private brands and kill them apart. So don't waste your time on them. As I said, it's in the past. They did well for you. Now it's time to move on, just like all good things in life.
So where should one really move on to now, Ajay? You mentioned that it's time to be extremely stock specific. Which are the pockets that would offer you that opportunity in this kind of a correction?
See, our largest portfolio's concentration change has been in hospitals, okay? And that's been the biggest segment we have invested in the last 12 months, a real concentration, and done reasonably well. Does not see the kind of vicissitudes you see of the market, because consumption doesn't go down in hospitals. At the end of the day, thanks to what we eat and drink and the pollution in Delhi, if you're part of Delhi, you will know it. We'll all end up in hospitals sooner or later. Therefore, hospital is the biggest segment that we have invested as a new segment. We continue to be in the hospitality spaces. Hospital is very large for us. Hospitality is second segment. Capital market related stocks are the third segment for us, which are there. And the whole host of new listed companies who have come into the market, some in CDMO space, some in engineering space. And, like there's a company out there which got listed last year, fantastic engineering company, does work with the global aerospace companies. Now that's the future of India. So it's been all have been our 80% of our portfolio today comes out of companies not in the Nifty listed at this point of time. There are 2 or 3 very large ones listed. That's all about it. But most of it is non-listed. Most of it is in segments of engineering is a large component of it. Hospital is the second large component. Hospitality and capital market related. Put some of that, I think, by and large, I think that's the portfolios that where we can be safely been. And they've done reasonably well. Believe me, in all this mayhem, couple of stocks have killed, but otherwise, most of them have done reasonably well, including the hospitals.
All right, those are the pockets of value at the current juncture. With that, Ajay, always a pleasure chatting with you.
Thank you very much.
Insights. Look forward to connecting again sometime soon.
You have a good day.
Thank you. Well, on that note, let me bring on. Thank you. Thanks a lot. On that note, let me bring on board another big voice that I had promised at the start of the show. Joining me is Mahesh Patil, CIO at Aditya Birla Sun Life AMC. Mahesh, as always, a pleasure chatting with you. We've corrected 10% from record levels. Just want to get in your sense as to where we are headed from here. Do you think much of the or bulk of the correction is out of the way, or do you see more downside from current levels?
Yeah, good morning. I'm happy to be on the show. So I think the correction, what we have seen is kind of much needed. I think if you look at the market breadth had been weakening for the last 3-4 months or so. And we've seen that a couple of reasons, I would say. One is the FIS selling, which has been very persistent in the last 1 month or so. And that is again on the backdrop of initially it was a China kind of a trade, but more because of dollar strengthening and redemptions in the emerging markets, what we have seen. So that's one of the reasons. And then earnings growth has kind of slowed down. We've seen some disappointments in this quarter, actually much more than what one would have expected. And that's led to this correction. But I would say post the correction, like for example, it's almost like a 10% correction from the recent highs, especially in the Nifty. At these levels, I think a lot of stocks, while Nifty has corrected by around 10% of the broader indices, there are many companies and stocks which are down by around, say, 20-30% or so from the peaks. And that makes it fairly attractive. There are a lot of options now we see in the market, which are companies at levels which are looking attractive to buy from the next, say, 3 to 5 year perspective. And even if you look at the Nifty for that matter, now post the correction, the valuations are much more reasonable. They are near the long-term average. It's almost similar to what the valuation was on the pre-COVID levels. So I think it's a good entry point, especially in the large blue chip names, which have corrected. In the mid cap and small cap, there could still be more some pain, because one is to be more careful over there. But clearly, the large frontline names look very reasonably priced at these levels.
I also want to get in a sense as to how the cash levels at mutual funds are looking like at the current juncture. Because if we talk about FPI holding in Indian equities, they are at a decadal low. With as you mentioned, the dollar index, of course, picking up steam and FIIs selling relentlessly. How are domestic mutual funds placed now in terms of cash levels?
So we know that a month back, right, when the September this time when we saw that, it was somewhere around 2 lakh crores was the cash in the domestic mutual funds. And looking at the kind of overall deployment, which would have happened, in the last 1 month or so on the back of FII selling, because when FII was selling, domestic mutual funds were the buyers at the other end. I would say that also there have been strong inflows, right? In the last month, we saw record inflows again into domestic mutual funds. Net inflow into equities was close to around 40,000 crores. So I would guess that, and FIIs have sold around 1 lakh crores, assuming that has been deployed. I would still guess that the cash would be somewhere around 1,25,000 crores or 1,50,000 crores in that range, which is still, considering that total equity AUM of mutual funds, is now close to around more than 40 lakh crores. So that is still around like a 3%, 3.5% kind of cash levels, which is what a rough estimate would be.
All right. You spoke about how this correction provides an opportunity to get into frontline stocks. Of course, we won't be talking about particular names, but in terms of sectors, would IT and Pharma feature on that list?
So I think IT hasn't really corrected in this recent fall. In fact, it has outperformed. But IT, we have been positive for some time, more as a counter-cyclical, which underperformed in the last year, right, on the back of concerns about US growth slowing down, and we saw the growth also came down sharply. But clearly, it's kind of bottoming out over there. And now with the outlook on the US looking a tad better than post the Trump coming back to power, I think the IT sector should continue to do well from here. Again, it's not a sector which has fallen too much in this fall, but there the earnings visibility looks fairly steady. And with the rupee depreciation also, that should probably aid in terms of the margins, which is there. Pharma has also actually done reasonably well in the last 1 year. Good defensive earnings there have been fairly good. So one sector where we have seen, in fact, IT and Pharma are two sectors where the earnings disappointment hasn't been that much. It's been still continuing. So in that sense, they would continue to, I think, the momentum, what they have, I think, should continue. But I think it will be good to look at sectors or stocks which have fallen, right, because of short-term concerns in this quarter, okay, which can provide attractive entry point.
Got your point, Mahesh. How are you approaching the PSU lot now? Most of those stocks have seen a 40 to 50% kind of correction from their highs. Is it time to reconsider and enter into these stocks, because valuations were a concern at one point in time? So post the correction, valuation-wise, have they become attractive again? And secondly, of course, government spending may pick up after the election lull. So is it time to really look at some of these defense names again?
Yeah, so I think PSUs had seen the biggest rally, last 2 years, and we've seen the PSU indices do well. Clearly, there has been a re-rating in the PSU companies than what it used to be pre-COVID levels. Again, they have come out from a long period of underperformance, right, from 2012, 13 to 2020, 21 or so. And again, it's been driven on the back of improved performance also of a lot of PSUs, including the PSU banks and companies in the energy and the oil and gas sector. So I would say that post the correction, okay, there are still certain pockets in PSU which are still probably valuations are still on the higher side compared to historical levels, or even after considering the growth. But clearly in pockets like, say, for example, energy, oil and gas sector, in the banks, there is value now which is emerging post the corrections. And as you rightly said, I think as the government spending picks up in the second half, which could be quite substantial because they have really spent, because of the elections, the spending has been well below the target, and the second half could see almost like a 40-50% increase than the normal level. So that could provide a boost to some of the companies in terms of activity levels. So I would say that especially in the oil and gas sector and the energy sector is where, or in the power sector is where we've seen, or utilities where the valuations are now looking reasonable, because I think the long-term outlook for some of the PSUs, I think they have now come of age. The balance sheets are in much better shape. The profitability is much better than what used to be around 5 years back. Better dividend payout policy. So I think at certain pockets, clearly there is now reasonable value which is emerging in the PSUs.
All right, that's the view on PSUs. Last question really, the Aditya Birla Sun Life BSE India Infrastructure Fund opens up today, and it's open through 28th of November. What really makes you bullish on infrastructure here on, Mahesh, if you would like to point out?
So I think if you look at the infrastructure space has again done well, because this recovery, what we have seen in the economy since the COVID, has been led by the capex, right? So capex, especially the government capex, has been at elevated levels, and if you look at the capex to GDP ratio, it had bottomed out pre-COVID, and it has gone up to around say 5.3%, which is likely to go to around 6.5% in the next 2-3 years. And the whole really plan for India to the next 25-year plan, the Atmanirbhar Bharat, is all focused upon making India self-sufficient, focusing on infrastructure growth. And we think that the spend on infrastructure will continue to be strong, especially in areas like infrastructure. Road is where the next level of capex growth will happen. We've seen a lot of good growth in the last 10 years, but I think there's a lot needs to be done over there. In railways, we've seen the last 2-3 years there has been substantial increase in the capex in terms of track laying, electrification on wagons, and I think all that deployment will happen in the coming years as orders will flow in. In the power sector, especially, I think there has been a big increase as India plans to have 50% of its energy coming in from renewables, and you would see renewables going up to around 300 gigawatts, okay, by 2030. So and alongside it, even in the thermal side also, we have underinvested there in the last few years. So I mean, suddenly we have woken up to a large kind of a deficit, okay, which could be there. So that's also catching up, and that means equivalent capex on the transmission and distribution side, which is there. Besides that, other areas like logistics, okay, where the government has a plan to bring down the logistics costs. So that's another area which still a lot of work needs to be done over there. On airports, the UDAN scheme, which wants to connect all the regional airports and the traffic, I think that's would also see good investment. So I think overall we see that while the sector has done well, I think it's a multi-year story from here. And more importantly, and this is all what the infra, but the private sector capex is only just like to begin from here, right? We've seen the corporate balance sheets are in good shape, and we are seeing early green shoots of private sector capex pick up, which will drive the whole capital goods sector growth also from here on. So I think it's a great theme for investors who want to play on the India growth story. It will be slightly more aggressive in that sense. We'll see some kind of volatility, I think, in these periods, okay, when markets, you might see some higher beta in the sector. But I think there are enough structural drivers for somebody who is even willing to invest at this point in time and look at for the next 3 years, 3 to 5 years.
All right, a bullish view coming in on the infrastructure and renewable space. With that, Mahesh, I would like to thank you for taking out the time and joining in this morning and sharing your thoughts with us. Always a pleasure chatting, and I wish to continue, touching base with you in the near future as well.
Thank you.
Thanks a lot. Well, on that note, we are just about managing to hold on to the positive zone. Nifty is around that 23,560 mark or so. Slim gains, but still some bit of semblance of normalcy after 5-day sell-off. And of course, the Nifty coming off 5-month lows as well. The Bank Nifty looking strong. 50,300 on the charts. Mid-cap index also holding its ground as of now, and the breadth is also tilted in favor of gainers. So, let's see how we really pan out for the day. Of course, it's the last trading day for the week, truncated week. Let's see how we end up for today. But with that, completely timed out on this edition of Opening Bell. Of course, we'll be touching base with the management of Zinka Logistics at 11:30 a.m. Don't forget to tune in for that. But for now, stay tuned to Money Control for all your other news and updates, and thanks a lot for watching.